Danielle DiMartino Booth, CEO of Quill Intelligence, is back to give us her forecast for the economy and Fed Reserve monetary policy. Danielle, welcome back to the show. It's a pleasure speaking with you today.
It's great to be here. Thank you so much for having me again.
Let's start with monetary policy. The big news item of the week is the Federal Reserve meeting. Powell's latest statement that he's going to keep rates low. He said it's going to be accommodative for policy for the next foreseeable future. How are you reading this?
I'm reading it as being very open-ended, and the market correctly interpreted Powell's dovishness. The last statement said that in the coming months that policy would remain accommodative, and now it is completely subjective. It is for the foreseeable future. It is until substantial progress, quote unquote, substantial progress has been made. He was pressed by reporters at the press conference to put a number on that, to say, are you going to stop when the employment rate gets to a certain level or GDP growth is here? And he refused to go there. And if you looked at the projections from internally from the Fed, they still don't anticipate being able to hit their 2% target until after 2023. So extremely dovish. On the other hand, not very specific at all. And I think a lot of that has to do with some of the mechanics, some of the limitations that the Fed has in terms of the percentage of certain securities that it can own through its quantitative easing program, the low level of nominal interest rates, and the fact that he sure does need Congress to pass legislation in order for him to have more treasuries to buy and grow that balance sheet.
I know that Fed monetary policy usually has a lag in terms of its effect on the economy. Are they not worried about having the inflation rate run up past their 2% target if they do nothing for too long?
Well, that has been their stated concern, even though they now have an average inflation targeting regime, which means that they will let it run hot in order to bring the average up, since they imposed that inflation target, which, by the way, was in 2012. And since then, they've only hit that target in 11 separate months. So it's a lot of lip service, because inflation is systematically, the way it's designed, the one that they follow, the core PC, it's systematically underreported. So the real question is what's going to happen with those Georgia runoff elections, and that could bring the specter of inflation that would be very unwelcome at the Federal Reserve.
Can you run us through some of the scenarios of the runoff and what that would do to the inflation rate?
Well, the only thing we know is that the races are neck and neck. I think clearly after the U.S. presidential election, we're not relying too closely on polls headed into these January the 5th runoff elections. We know that hundreds of millions of dollars are pouring into these states, mostly from out of Georgia. Most of the money that's because the stakes are so high that the voters should be looking at this, if you will, as a referendum on socialism. And that is what should give Jay Powell pause. He says that he wants massive fiscal stimulus spending out of Washington in order to help people that Fed policy cannot get to. Obviously, the small business owner, the 20 plus million Americans collecting unemployment insurance benefits. That number rose 1.6 million just in the last week. But it's a matter of watch what you ask for, because if the Senate does flip to the Democrats, then we go back to the blue wave scenario. And the reason that bond yields had started to tick up, because you're no longer talking about gridlock in Washington and wrangling over $908 billion, but you're talking about the ability to pass trillions upon trillions upon trillions of dollars of stimulus legislation, universal basic income, Medicare for all, new Green Deal. A lot of money could be spent. The Treasury could issue a lot of debt over the next 2 years between now, let's say, in the midterms, which is why those two are so critical. If you get that magnitude of legislation and stimulus spending, I don't think the Fed's going to have to worry about a 2% inflation target anymore.
Right. Now, you told me offline that the Fed needed this black swan in 2020 to execute some of the long-term plans. Am I correct to say that? What do you mean by that?
So a year ago, had we been chatting with each other, we would have been talking about the Fed continuing to move the goalpost and increase the size of its not QE program. It was very, very articulate in making sure that people knew that these were just technical adjustments, just tweaking it here and tweaking it there, even though it was increasing the size of the balance sheet at the same pace as that which we saw during the quantitative easing initial phase after the great financial crisis. So what the market was beginning to communicate to the Federal Reserve, which, boy, it was bad news to the Federal Reserve, was that counterparty risk was becoming in question. Credit risk was becoming a question. We had non-financial debt as a percentage of GDP coming into 2020 at 78%. That is higher than any ratio ever recorded in U.S. history, including the peak of the great financial crisis, which was 74%. There was a corporate credit bubble that was threatening to burst as we enter 2020. Global trade had been negative for the entire year. The U.S. economy was already starting to slow, and it was veering much more slowly into a recession. But that is why credit risk was starting to become so apparent to investors. If you want to be able to resolve credit risk, though, you have to be able to launch massive quantitative easing, which the Fed was remiss to do because that would have conceded that there was a big problem. Then came COVID, and as you know, they had a prepackaged game plan bazooka full of emergency measures that were ready to go immediately. And on March 23rd, they did, and he managed to very quickly bail out the corporate bond market.
What I don't understand from Powell's statement is why he needs to be accommodated for the foreseeable future. Like you said, deficits are expected to rise in the wake of doves in the government. Janet Yellen, we know she was dovish when she was helm of the Federal Reserve. Now she's at the Treasury. Economists have agreed with you that fiscal stimulus is coming either way. With fiscal stimulus on the way, why do we still need accommodated monetary policy?
Well, I mean, I think it also goes to financial conditions being as accommodative as they have ever been on record, and the stocks being at record highs. We've seen well more than $2 trillion of fresh debt put on corporate balance sheets in this year alone. It's blown past any prior annual record. It's quite apparent that the capital markets are functioning fine and liquidity is not an issue. And so you must ask yourself, with interest rates still near 5,000-year lows, why on earth it is incumbent upon the Fed to keep interest rates so low, because their policy has already proven. Powell has conceded to the fact that monetary policy cannot help the people who are out of work, that needs to go to the fiscal authorities. So all he's doing by keeping monetary policy this accommodative is levitating the financial markets and feeding a bubble that already exists. And looking back at data through to 1881 with Robert Shiller's CAPE PE ratio, the 10-year PE ratio, the S&P 500 right now is in the 98th percentile of valuations. And it looks like the addition of Tesla alone is going to increase that PE ratio by 10%. So by time, if we were to be speaking a week from now, the S&P 500 will be in the 99th percentile of historic valuation. So I'm not quite sure, I'm right there with you, why it's so incumbent upon Jay Powell to remain this accommodative.
I think you get asked this all the time, but if you were helm of the Federal Reserve, what would you do? What would you do differently? Do you agree with policy today?
I do not agree with policy today because it's taken a problem of insolvency and made it that much worse. You know, Jay Powell had the opportunity. He could have put a floor underneath the economy, but still allowed companies that were effectively walking dead to go into restructuring. And instead, the policy has created 1 in 5 American companies that are zombies, so to speak. And that's going to make the future productivity, the future ability to achieve escape velocity during a recovery that much more difficult. So, I would allow the markets to go back to where they are. In the press conference yesterday, Jay Powell was adamant in insisting that those credit facilities that are going to expire on December the 31st, that they can come back if need be. So he's still ready to continue bailing out insolvent companies that will be a drag on U.S. growth in the future. If I was the head of the Fed, I certainly would not be taking such steps that hinders economic output in the future.
Yeah, let's talk about U.S. growth now. Your outlook for 2021, can growth continue to grow at the pace it has in the last couple of months? We're seeing a rise in COVID cases. Unemployment claims are up. What's going on, Danielle?
We are, I think between the retail sales report that was weak and the jobless claims, now it's clearly a trend. If you ask an economist, they need three prints of data in order for something to be established as a trend. So we have a trend of rising unemployment claims in this country, and we're seeing more of the country shutting down involuntarily and voluntarily. People are less mobile going into the critical holiday shopping season. So there is a real risk growing that the United States could slip back into contraction in the first quarter. It's a foot race right now between the damage being exacted by the coronavirus and how quickly vaccines can be disseminated throughout the economy such that we're able to be fully mobile once again.
Is there anything that the Fed or Congress could do to reverse this possible contraction?
Well, that's a good question. And there is small business relief in this coming stimulus. But when you consider how long the gridlock has put a pause on helping small businesses, the only thing I can think to say is shame on you, Congress, because so many small businesses have been unnecessarily sacrificed because there's been such a huge amount of backbiting in Congress. So I think we're permanently going to lose many small businesses, and that is going to make the ability of the economy to regenerate, be reborn, that much more difficult. So I completely applaud the vaccine. I'm excited for it. I'm excited for everybody to be able to get out and help the American economy grow. But I think it's also equally naive to assume that the damage that has been inflicted upon the U.S. economy is going to disappear overnight.
Let's tie all this together now, Danielle. Where do you see inflation headed given rates are likely to remain low? And like you said, the economy may not do very well.
Well, I think that it, again, I go back to those two Georgia runoff elections because that's going to determine the magnitude of fiscal spending that we see. And that's going to determine the risk that interest rates rise of their own volition. If they do, I think the Fed would certainly launch yield curve control and try and cap those rates. But once again, inflation is something that once the genie's let out of the bottle, it's very hard to get her back in. If those two Senate runoffs keep the GOP in power of the Senate, then we'll have more gridlock. We won't have the same level of fiscal spending. And that will make it more probable that inflation will not be problematic, but rather a slowing economy.
Your favorite asset class for 2021?
That's a good question. My favorite asset class for 2021. I have to say that it's been beaten up so badly that I have to say that gold has to be right up at the top of my list.
All right. Thanks very much, Danielle. I want to thank you so much for coming on the show and giving us your updates. Merry Christmas and have a Happy New Year to you.
Merry Christmas. The same to you. Thank you.
And thank you for watching Kitco News. I'm David Lin.